All right, in this lesson, we're going to be looking at the different types of costing method. So to kind of give you a preview of what we're trying to do here in this lesson is we're going to set you up with an overview of what you're going to be learning for the rest of this section. In this section, we are talking about the different types of costing method that is available to us as accountants. Now, what is a costing method? Well, the costing method tells us how much are we going to transfer from inventory to cost of goods sold. And we have 4 different types of costing methods that when applied may mean different amounts are going to go from inventory to cost of goods sold for the same item that we sell. And there's a reason for that, and we're going to show you that in an example in this lesson. So let's get started and help you understand what we already know first. What do we already know? Well, when we go out and we buy inventory from our vendor, whatever it costs us to acquire it and put it into our stores, that cost gets transferred to the inventory account. Right? So if we buy product X and it costs us $100,000, then product X, we would debit inventory for $100,000. Then we know that we don't move the cost from inventory to cost of goods sold until we sell them. So when we sell them, we're going to credit inventory and move that cost to the cost of goods sold. So that's what we already know, right? We buy inventory, we put it into the inventory account by debiting the inventory, crediting maybe cash. And then we need to move it from inventory to cost of goods sold once we've sold it because we no longer have possession of that inventory item. So that's what we already know. So looking at it from a journal entry standpoint, the journal entry would be reported as follows when we make a sale. Now remember that there are 2 transactions when we make a sale, one for the sale, one for the cost of goods sold. I'm omitting the sale entry here and just talking about the cost entry. So from a cost entry, when we do move the cost from inventory to cost of goods sold, we would debit cost of goods sold for whatever the amount we're going to move, and we're going to credit the inventory for the reduction of that inventory from our inventory account. So that's what it looks like from a journal entry standpoint. But what would happen in this situation? Okay, so here's a situation. Let's say we have 2 globes in our inventory. So I have 2 globes in our inventory at the start of the year, and they're on my shelf and they're ready to be sold. But the problem is I sell more than 2 a month. So obviously I'm going to need to go and buy more. Well, the 2 globes that I have on my shelf originally cost me $15 each, and I sell it to my customers for $20. Now I go out to my vendor and I say, hey, we're going to need to buy 4 more because I'm running low on this inventory in my store. So unfortunately, my vendor goes, look, we had to increase the price is going up, so we can't sell it to you at 15, we have to sell it to you at 16. So we agree to buy 4 more at $16 a piece. Now, for whatever reason, just for our example here, we didn't raise the price. So the price that we sell it to our customers, we're not raising, we're just gonna absorb the extra cost. So now we have 2 globes that are on our shelf that cost us $15, and then we buy 4 more that now cost us $16 a piece. So if I look at my inventory T account here, we started the year with $30, and now my inventory goes up by $64 because I bought 4 more globes at $16 a piece. So now my inventory is $94. Okay, so we've got $94 here of inventory. Nothing strange out of the woodworks here. Everything is straightforward. Okay, but let's take it one step further. What would happen if we sold 1 globe? And so I'm just going to pick a globe here. I'm going to pick this globe right here. So customer picks up that globe from my shelf, and that's what they want. So that's what we sell. So now I have 5 globes left. The question is, which costs do I move from inventory to cost of goods sold? Do I move the 15? Do I move the 16? Do I move some other amounts? And that's the predicament that we have, and that's why we have these costing methods to figure it out. The answer is not necessarily 15. The answer is not even 16. The answer is another question of what costing method are we using to transfer the cost from inventory to cost of goods sold. So again, giving you an understanding of why this is important as we talk about these costing methods. Now, before we talk about the other types of costing methods, it is important to understand the cost that moves from inventory to cost of goods sold may not necessarily follow the flow of inventory that is sold. So notice that the customer took a $16 globe, but we may decide that we are going to move $15 in our T accounts. So what I'm saying here is that the inventory flow may not match the costing flow in our books, and that's okay, okay? So as such, it's okay that the customer takes the one that just came in and we expense it as if it was the first one that left. So again, it's okay if they don't match, okay? Now, let's talk about the 4 different types of costing methods. We're just gonna give you an overview, and in the next few lessons, or the rest of the lessons, we're actually going to show you each one of them specifically. So let's talk a little bit about the 4 different types. The first one we have is a very easy one. It's the specific identification. We're specifically identifying the product to their cost. The second one that we have is the first in, first out. We like to say FIFO. So FIFO, never mind. So first in, first out is one method. The other method that's related to it but is opposite of it is called LIFO, or last in, first out. And then the last one that we have is can be a little bit complex, but it's the weighted average. So we have specific ID, first in, first out, or FIFO, last in, first out, or LIFO, and then the weighted average. So that is a look at the different types of costing method, and specifically in this lesson we talked about the why. Why do we care about these costing methods? Well, we need to care because we're going to have a situation where we buy goods at one price and then we buy more goods at a different price, and now we're confused on which price or cost needs to move from inventory to cost of goods sold, and these methods will help us make it easier to understand what costs we're actually moving from one account to the other. So hope you enjoyed this lesson. We'll see you in the next video. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? It would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.